One of the biggest misconceptions about money is that you have to work for every single dollar that you earn. That's what we're taught at school, it's what our parents were taught, and it's something that most people never really stop to question. You study, you get a job, you work hard, you take on a mortgage, and then you spend the next few decades of your life trading your time for money. And if everything goes well, you hopefully get to slow down later in life. There's nothing inherently wrong with that path. A lot of people actually take it, but it does have a major limitation. And that is, if your income only exists when you're working, then your ability to earn money is always tied to your time, your energy, and your health. If you stop working, then the income stops too. What often gets left out of this story is the idea of building income that isn't directly tied to your time. So that means income that comes in from assets that you've built over time. That's really what people mean when they talk about passive income. Now, I don't think there's such thing as completely passive income. There's always some effort involved somewhere in making the money that you make. But there's a big difference between having to work for every single dollar and having income that keeps coming in even when you're not working. And that's really what this video is about. I'm going to walk you through 3 passive income ideas and share what they actually look like in real life. All right, the first one we're going to talk about is rental income from investment properties. So this is the main one I'm personally using to build my passive income. And to make this real rather than just theoretical, I currently own a few investment properties that bring in around $7,500 a month in rent, which is roughly $90,000 a year. And I want to be very clear here because this is where a lot of people get confused. That rental income I'm talking about is not the same thing as profit. Once you factor in the interest I'm paying on the mortgages, the insurance, council rates, property management fees, and all the other ongoing costs, I'm still roughly around break even to slightly negative each year on my investment properties. So if you're thinking that doesn't sound very passive, you're not wrong. But this is exactly what property investing looks like in the building phase. Property isn't really about what it does for you in the first few years. It's about what it looks like over 10, 20, 30 years. When you buy an investment property, you're not just buying the rent that you're going to collect today. What you're really buying is what the property can do for you over time, over many decades. And a few important things tend to happen as time passes. Rents usually increase due to inflation, wage growth, and demand for housing. And your loan balances gradually come down because you're making repayments on the mortgages. And if you bought well, the property itself should grow significantly in value for you. In the early years, those benefits aren't very obvious. Property can feel very financially uncomfortable at the start because you're putting a lot of money in, you're dealing with maintenance, and you're not seeing much immediate reward. And that's completely normal, and that's the phase I'm in right now. But over time, the numbers tend to shift. Rents rise, interest costs shrink, and loans reduce. So eventually, properties that once cost you money start covering their own expenses, and then they start producing you surplus cash flow or passive income. In Australia, if you're buying the right properties in decent locations, a 4% rental yield over the long term is a fairly reasonable assumption. So just to put some numbers around that, a property portfolio worth around $3 million at a 4% rental yield would generate around $120,000 a year in rental income. And that's when property really starts to feel like meaningful passive income. Of course, property investing also comes with risks. You need to be comfortable with debt, you need stable income to be able to service all the loans, and you also need to be able to handle things like vacancies, interest rate rises, and unexpected costs. And it's also not completely hands-off. Even with property managers, you still have to make maintenance decisions, do admin, and bookkeeping too. But compared to the long-term income potential, the effort is relatively manageable, and that's why property is my main passive income strategy. Another common way people earn passive income is through dividend-paying shares. This is often the easiest place to start because it's very accessible. You can open a brokerage account on your phone and start buying shares within minutes. So when you buy shares, you're buying a small ownership stake in a company. And some companies choose to pay shareholders a portion of their profits in the form of dividends. Historically, dividend yields might sit around 2 to 5% per year on your investment. You can chase higher dividend yields, but that usually comes with higher risk. And in some cases, unusually high dividends can even be a warning sign about the quality of the investment. Shares can also grow in value over time, which is referred to as capital growth. Some people sell part of that growth to fund their lifestyle, but personally, I'm not a big fan of that approach. For me, passive income feels more sustainable when the income is being paid to you without having to sell the underlying asset. So with investing in shares, markets can go up and down, dividends can be cut, some years might be good, some years might be weak, and just like property, scale matters as well. So to earn 60 grand a year with a 3% dividend yield, you'd need around $2 million invested. So shares can absolutely play a role in a passive income strategy, but like property, they still require patience, discipline, and realistic expectations because the ride can be bumpy at times, like property. Another powerful way to build passive income, especially today, is by building a business around a community. So that might be through YouTube, blogging, podcasting, or some other platform where you consistently create content and build an audience over time. So this is definitely not passive in the beginning. In fact, it's probably the least passive option of the three I've talked about today. Early on, it's a lot of work for very little return because you're learning how to communicate and structure ideas and speak on camera and edit and hold attention, often while talking to a very small audience. And from my own experience on YouTube, I think consistency matters more than anything else. You really do need to be publishing regularly, and you need to explain things properly and genuinely try to help solve other people's problems. So you need to expect a steep learning curve at the beginning with scripting and filming and storytelling and editing, usually with very few views and no money coming in at first. And this is where most people quit. But if you stick with it, say 50 to 100 pieces of content, something tends to shift over time. You start to get feedback and understand what resonates with your audience, and your delivery gets better and your ideas get better. And slowly but surely, you build a real audience. The first 1,000 subscribers is usually the hardest milestone when it comes to a platform like YouTube. But once traction builds, that older content that you made that no one really watched starts generating views and bringing in traffic and income as well. Each piece of content you make should really be thought about as like a mini asset that's eventually going to pay off. The great thing is that you can earn all kinds of different income streams from this kind of thing, like ads, sponsorships, affiliate marketing, and digital products like courses or ebooks, templates, planners. I think digital products in particular take a lot of upfront effort, but once they've been built, they can just be sold repeatedly with very little ongoing work. And all of this really just comes back to the same foundation, which is you have to build the community first. And that takes time, consistency, and patience, much like what it takes to achieve a passive income from investing in property and shares. So if there's one thing I want you to take away from this video, it's that passive income isn't about taking shortcuts. It's about building assets that can support you over time, instead of relying entirely on your ability to work. So whether it's property, shares, or a business, the pattern is pretty much the same thing. You always need to put in the upfront effort. And then you just need to be patient over time and consistent, and then let compounding take over and get you the results that you deserve. So if you found this video useful, guys, please feel free to subscribe and like the video. If you want to go deeper into this topic, I've made another video on your screen right now where I share my honest advice for anyone who's chasing financial freedom. Thanks so much for watching, guys, and I'll see you in the next one. Bye bye.